Welcome back. Now, we've just seen the SARB cut rates by 25 basis points. The move coming right after Treasury came out in support of the lower inflation target. I caught up with FirstRand's Mary Vilakazi and she shared her views on the new 3% target. Before that, though, she unpacked how businesses have had to navigate a volatile year and Africa's economic outlook. Here are those insights.
I'd have to say the year's been challenging. It's presented a lot of disruption, but from disruption, normally that's where innovation comes. But I guess as businesses, we've had to contend with living with uncertainty, volatility. And so ultimately as businesses, and I think people across the continent, we've realized it's so important for us to make sure we've got resilient business models.
Yes.
We've got resilient communities. And I think the focus is going on the right things, the resilience of countries. How reliant are you on another country?
Mm-hmm.
Who do you trade with? So I think it's forced a lot of people to go back to basics.
Yes.
So that's a good thing. And I guess from a financial services point of view, we've certainly seen a lot of shifts enabled by technology.
Mm-hmm.
I'd have to point that out as being a big driver. The level of investment that's gone into the digital infrastructure, particularly by telecoms, by technology companies, I think has really enabled Africa to take a leap step actually in terms of financial services. So the number of fintechs that have been started, really focusing on providing customer solutions to people we considered unbanked, underserved.
Yes. Yes.
That numbers actually, the penetration in those communities has increased quite a lot. I would say as a bank, we've started leveraging data that we never used to look at in the past to enable lending to very small businesses. Mm-hmm. That in the past would have said, okay, give us 3 months of bank statement, and the person says, I don't have. Yes, so I think, and I don't have a balance sheet, I don't have a track record. We've done a lot more to make sure that we are finding other alternative sources of data that can tell us this person is going to be able to repay back. Again, technology and data allows you to do that. And then lastly, I would say that as financial institutions, we really are stepping up, trying to step out to this mandate of saying Africa has got plenty of opportunities.
Yes.
Pension funds have quite a lot of significant money on their balance sheets that could fund infrastructure. What are some of the impediments? And that's where the B20's focus is really most helpful, because you get the brains together and hopefully we'll make the recommendations that land with the G20, because I think if we can harmonize a few rules, we won't get everything that we asked for, but if just a few rules to really make sure that it can be made easier for banks working with development finance institutions, working with various governments to unlock some of these projects that we know are going to be catalysts to providing infrastructure, to providing jobs, to getting the economy to be a lot more productive. We are seeing that in Transnet, that if you just put the right focus, okay, now the volumes that we export can increase. I think what the B20 has done is create the platform for some of these topics to be lifted. Yes. The importance of trade, investing in agriculture, investing in the climate resilience, and really making sure that financial institutions are focused and working together to make sure that we can bring the cost of capital down so that more can be done and make Africa sustainable. But I'd have to say that it's been hectic. It's presented innovation.
Yeah.
And I really think it has created constructive optimism about business and the people of the continent to unlock more of that for Africa's growth.
You touched on some important points there, issues around, sentiment when it comes to South Africa. You touched on Transnet and the work that's being done there. We know that is also of a result of public-private partnerships. And just looking in on South Africa, we have seen sentiment shift, right, from the back of the mini budget that Finance Minister Enoch Godongwana presented to being removed from the grey list and that S&P credit upgrade. Just from your standpoint, your view as the top helm there at a financial services company, what does this do for South Africa's investment case? Because on the ground, things are tough, right? We're dealing with high unemployment rates. We're dealing with low economic growth.
So I have been saying that, in South Africa, the next 10 years, this is from when I took over as CEO last year, I was cautiously optimistic that the next 10 years are going to be better than the previous 10 years.
Yes.
And I know that these things take a long time before on the ground effects they're felt. But what have we done? Interest rates have come down over a lot during that time. Inflation has come down. The latest inflation target by the South African Reserve Bank has again created some impetus, because in the long term, South Africa has to bring down the cost of debt. Yeah, and then the cost of capital has to come down so that investors can look at South Africa as a destination. We know that there are plenty of opportunities, but if we can remove a lot of the structural impediments, it was important for business to partner with government to say, how do we get electricity supply so we can get manufacturing back, because that speaks to employment? How do we get confidence back? How do we get Transnet working? So I'm encouraged with the progress that's been made on those structural economic reforms. It will take time for the trickle-down effects to take place, but we know that if the right things are happening, it really does help, because we get the confidence as a country to tackle the next pieces. So interest rates will be high over the next 2 years as we transition to this much lower inflation environment.
Yes.
But what inflation does, it hurts the poor the most. If we live in a low inflation environment and interest rates can start coming down to below 6%, back in the 5% in 2 years' time, because I think there'll be a period of time where they remain elevated. But that environment will make it easier for people to buy homes.
Yes.
Will make it easier for people to not feel the pressure that they have. We can start thinking about an economy that is growing, because our economy hasn't been growing. An economy that doesn't grow doesn't create jobs, doesn't create opportunities. And so even for businesses, I think access to finance will be they'll be in a much better environment. They'll hopefully be able to export whatever they have, because now we've got infrastructure. So I almost think that if we can get political stability over the next 2 years, continue with the momentum behind the reforms, South Africa definitely is on the right track, I think, to reverse a lot of the damage that's been done. And then we need to start focusing on ensuring that our young people actually have skills. That's the one thing that still concerns me, because ultimately there's no nation that can grow when you don't ensure that your people and the talent that should solve problems are not sufficiently and adequately skilled to participate in this world where technology is going to be quite disruptive. So overall, I'm really feeling very pleased about where we are as South Africa, and really hoping for political stability. That's the one thing that is within other people's control. If we continue on that path, we are really on an encouraging footing.
Mary, just on the other side of that inflation target coin, right? We talk of short-term pain for long-term gains.
Yes.
And there's this argument that's been presented that perhaps the timing of this move is not right. I think of cost of capital when it comes to SMEs that are currently dealing with, the US as a market, where there are those tariffs, where AGOA has also been cancelled, it's ended. How do we go about addressing those concerns?
So I think we must see it as this transition period that is going to result in real rates being high, and that's your point. During that time, perhaps this interest rates could have come down faster if we're targeting the lower inflation target. So I have sympathy with the people that are impacted there, but I guess if you sit back and you say, how does our inflation target, the old one now, how does it compare to other countries who we also compete for capital? I think our inflation target was already outdated. So that means that you can sit and have the benefits over a short period of time of maybe not taking the pain, but in the long term you miss out. And so I really do believe that it's the right thing that the central bank is driving and the finance ministry. As difficult as it will make the next 2 years,
Yeah.
you almost have to think, say, well, interest rates are lower than they were 18 months ago, as a bit of a consolation
Relatively
prize.
so, yeah.
If I survive that period, okay, I can make it here because the promise of getting to the other end is there. And remember, this is an opportune time, because even though the latest inflation print suggests inflation is going up a bit, it's still in the 3% range.
Yeah.
So if this is a good time, because it's not like you are at a 6% inflation and then trying to
Yes,
push it down to
yes.
3. And so hopefully the oil price, the stability, and then we can go back again to a trajectory. But inflation is already low. It's about just making sure we are now capturing on lowering inflation expectations going forward. So I think the timing is perhaps ideal, and you probably don't get an opportunity like that again. So I think we all have to rally behind our policymakers. This was not an easy decision to make. I think for the finance ministry it's even more difficult.
Yeah.
But we all have to rally for the long-term prospects of our country.
That was Mary Vilakazi, CEO of FirstRand.